Hey guys, this is Joe Beckford with Goodwin Investment Advisory. I'm one of the advisors here. Just wanted to put out a quick video with some tips, some gut check questions for you to ask yourself in times of all of this emotion that's going on right now in the markets and in the world in general. It's really easy to listen to everything and feel like, oh my gosh, I've got to do something right now, when actually what you might want to do is just calm down, have some peace, and turn off the noise. So I'm going to ask you some questions. I'm going to raise a couple of points about investing, and then I'm going to talk to you a little bit just about emotional check. So first, some of the questions to ask yourself right now. Right now, the Fed has dropped interest rates to some historic lows, right? And a lot of that is to keep liquidity markets moving. And that's typically a good thing. Last time we saw this kind of thing was in 2008, which obviously that was a bad time in the U.S. economy, but it was necessary to get us kickstarted again. So a lot of people would look at that and go, wow, interest rates are being slashed and these are all these terrible measures. That must be horrible signs for the economy. But ask yourself this question. Any other time, are interest rates that are historically low good for the economy or bad for the economy? I think the answer is they're good. They get things moving. They get money moving through the economy. Would lower energy prices normally be good for U.S. consumers and businesses or bad? I think we all know the answer to that. Low fuel costs help drive the economy, and that's where we are right now. Before the coronavirus outbreak, was the U.S. on solid growth path? And did we have modest inflation? And did we have strong job growth? The answer is yes to all of those questions. And right now, yes, we are having job loss. Restaurants are having to close. Businesses are having to close. People are having to keep their distance. People's portfolios are down, so they're not spending money. But the reality is, once this is over and we're able to start getting out and start getting back to work again, all of those fundamentals are still in place. So we're looking for a comeback, hopefully sooner than later. Another question to ask yourself, are U.S. banks in strong financial positions with steady loan activity and cash-rich balance sheets? And the answer is yes. And thanks to the Fed and some of the moves that they've taken recently to lower interest rates and keep things moving, banks are still going to be in good positions to still extend money. And once the dust settles and the current crisis kind of abates, are we going to be left with record low interest rates, record low mortgage rates, record low energy prices, the opportunity for job growth, and attractively priced stocks? Because we all know stocks are down now. And the answer to all those questions is yes. So we really like to look at this as a hiatus from the bull market that we've been experiencing, particularly since 2009, rather than a stop, rather than a halt. It's really a break. There's some key points about investing that I want you guys to keep in mind. So over the last month, we've had a lot of volatility, most of it down, as you guys are aware, and it's easy to freak out about that, right? So here are some points to keep in mind. The Dow Jones Industrial Average, which is the Dow we watch all the time, had its 5 single point day drops just this month. But so have its 4 best days in the history. Now, point days. Now, granted, the average is higher than it has been in the past, so points mean a different percentage. But just think about that for a minute. So you hear about, oh my gosh, this is the worst 5 days ever. It's always the worst drop ever. Do you hear about it's the biggest rise ever as well? And you don't hear that as much. Now, one thing that is really important is to know that you need to be invested in the market. If you're not already, if you're already in cash, that's a little bit different story. But if you're invested and you're thinking, should I get out? The answer is no, you should not get out. When you get out, when you think it's going to be a downtime, you're going to miss the uptime. And I want to read this to you. This is kind of impressive. This is from a study that Bank of America recently did, and they went all the way back to 1930. And they looked and they said, if investors stayed in versus they got out during the volatile times. And this is what they said. Looking at the data going back to 1930, Bank of America found that if an investor missed the S&P 500's 10 best days in each decade, that total returns would be 91%. So that's from 1930 to now. So 90 years, you would have made a 91% return. Doesn't sound terrible, except that if you had been in during the 10 best days over each of those decades, your return would be 14,962%. You would have missed out on a ton. And that's just by being in the market the best 10 days of a year. Well, how do you know when that is? The answer is none of us know exactly when that is. And the only way to be in those 10 best days is to be in the market. That also means you're going to be in some of the worst days. It means don't get out during the worst days because it's going to be almost impossible for you to time yourself to get back in. I also want to let you know a few things about just emotions. So a lot of you are familiar with the term day trading. We don't do that at Goodwin Investment Advisory. We are buy and hold index investors around here because we don't believe over the long run that day trading can work. This is from one of my favorite authors, this Seth Godin. It's a guy that I follow a lot. And he puts out a blog every day. If you've never checked it out, it's worth looking at. Well, he had a blog recently, and I want to read that to you. It says, when the stock market is on an upward tear, day trading becomes popular. You sit in your basement, you're surrounded by terminals and tickers, and you search for the latest bits of information, and you hope you're going to make a profit from buying and selling based on what's happening in that very instant. Not a great idea to do in general, certainly not a good idea to do when the market is down. But the point he's making here is that we tend to day trade our emotions, and it's really easy to do, right? You're watching CNN, you're watching Fox, you're watching every other news outlet. Everybody is trying to be heard. Everybody is coming at you with all kinds of information, and it is very easy to let your emotions go up and down and up and down and up and down and up and down, almost as volatile as the stock market is going. He calls that day trading your emotions. He says, we've piped in the voices of 1 billion people directly into our brains. The loudest, angriest, most frightened people are usually the ones that get amplified the most. And that's true. That comes along. And it can affect your psyche. It can affect your brain. And you'll notice we've been putting out some videos to try to get yourself in a positive energy place because there is certainly enough out there that's going to bring you down and cause panic. And panic is not going to serve you in the end. So then he says, just as it's nearly impossible to make a profit as a day trader, it's really difficult to be happy when you day trade your emotions. But there's an alternative. It's called buy and hold. Stand for something and stick with it. Your long-term contributions matter. Today will end today. Tomorrow starts again. But you only get one long-term life. And I just love that because it relates to our investment philosophy. We are in it for the long run. We don't day trade. We're not market timers. We're in it, and we're in it for your long-term benefit. And like we say, we're in it to win it for that. And we feel like that's the best strategy. And we feel like for your emotions, that's the best thing too. So when you get excited, when you get anxious about everything that you hear, step back, take a deep breath, take stock of the blessings that you have, and realize that your money is there. You have the same number of shares that you had before when this all started. Hold on to them. They will come back. We're in the long term to win this. Last thing I want to leave you with is a quote from an author. He was a late 20th century author named James Lane Allen. He says, circumstances do not determine a man, they reveal him. These circumstances are terrible. They certainly are. It's terrible to watch our portfolios down, but how we react and how we respond to our neighbors and our friends, how we take care of our families, how we take care of ourselves is really going to be the ultimate way that's going to show how well we recover from this. So I encourage you all to just take stock of all the blessings that you have an attitude of gratitude, and understand that we are going to get through this. That will define your character as being a winner in the long run. Thanks so much.